Every time you pay for something, you make a choice. It feels insignificant. Tap, insert, swipe, debit, or credit. Most people treat that choice like it doesn't matter. They think it's just a preference. Some say, I don't like debt, so they use debit. Others say, I want rewards, so they use credit. It feels like personality. It's not. It's strategy. And here's the uncomfortable truth. One of these tools gives you leverage, the other gives you restriction. One builds optionality, the other limits it. And most people are choosing based on emotion instead of structure. They think they're being responsible, they think they're being cautious, but in reality, they're giving up protection, flexibility, and financial positioning without realizing it. This isn't about which card is safer, it's about which system puts you in control. And if you've been defaulting to debit because it feels simpler, there's a high chance you've been choosing wrong. Let's strip it down. A debit card connects directly to your bank account. When you spend, the money leaves immediately. No delay, no buffer, no float. It feels clean. You see your balance drop in real time. Psychologically, it feels disciplined. You can't spend what you don't have. That sounds smart, but here's the structural issue. When you use debit, you are exposing your own cash to risk every single time you transact. If fraud happens, that's your money frozen. If your card gets compromised, that's your liquidity locked. Yes, banks investigate. Yes, you'll likely get reimbursed. But during that process, your cash is gone. And cash flow is power. With debit, you are always paying first and asking questions later. There is no shield, there is no intermediary, it's direct access to your core reserves. Now ask yourself, why would you expose your capital if you don't have to? Credit, when used strategically, flips the structure. When you swipe a credit card, you're not using your money, you're using the bank's. For a short period, you are operating on float. Your cash stays in your account. Your liquidity remains intact. Your leverage increases. And if fraud happens, it's not your money missing, it's the bank's problem. That distinction matters. Credit creates a buffer between your assets and the outside world, but that's only the surface. Here's where it gets interesting. Used correctly, meaning paid in full before interest, credit becomes a tool of optimization. You build payment history, improve utilization ratios, strengthen borrowing profile, earn rewards, extend cash flow timing, all without paying interest. That's leverage without cost. The mistake people make is assuming credit equals debt. It doesn't. Debt is unpaid credit. Credit is a tool. Debt is mismanaged timing. And confusing those two ideas is why so many people default to debit out of fear. They think avoiding credit equals avoiding risk. But sometimes avoiding leverage is the bigger risk. Here's why this debate gets emotional. Debit feels safe because it limits you. It prevents overspending. It creates immediate consequence. It removes temptation. For someone who struggles with impulse control, debit can act as a behavioral guardrail. But guardrails are not growth tools. They are damage control tools. If you need debit to prevent overspending, the issue isn't the card, it's spending discipline. And here's the deeper problem. Many people use debit not because it's optimal, but because it feels morally superior. They equate credit with irresponsibility, they equate debt with failure, so they reject the entire system. But the financial system is built around credit, mortgages, business loans, auto financing, investment leverage. Your credit profile determines access. If you never build it intentionally, you reduce future optionality. And optionality is everything in finance. Debit keeps you contained within your current resources. Credit, used properly, expands your strategic range. The question is not which one prevents mistakes. The question is which one builds strength. Now let's be honest, credit becomes dangerous when it's used emotionally, when spending decisions are based on limits instead of income, when rewards justify purchases, when balances carry over, when minimum payments become normal. That's where people get burned. But notice something, those are behavior problems, not structural problems. Blaming credit for overspending is like blaming a gym membership for lack of discipline. The tool amplifies your habits. If your habits are strong, credit accelerates you. If your habits are weak, credit exposes you. Debit hides weaknesses, credit reveals them, and most people would rather hide than fix. So they choose debit and call it responsibility, but responsibility isn't about avoidance, it's about control. The highest level of financial control is using credit for every transaction while never paying interest. That's mastery. You capture rewards, you protect liquidity, you strengthen your credit profile, you maintain leverage, and you pay nothing for it. That is the correct choice. Not emotionally, structurally. Here's the simple framework. If you lack spending control, fix that first. Track expenses, lower discretionary spending, build cash reserves. But once discipline exists, default to credit for transactions, not debit. Use credit for daily spending, subscriptions, travel, online purchases, large transactions, and pay it off completely every month before interest hits. Treat your credit card like a charge card, not a loan. Debit still has a role. ATM withdrawals, situations where credit isn't accepted, certain budgeting systems. But as a primary transaction tool, debit is inferior. It offers less protection, less leverage, less upside. This isn't about preference, it's about positioning. The financially strategic person does not avoid credit, they weaponize it carefully, deliberately, without ego. So the next time you're at checkout and you instinctively reach for debit because it feels safer, pause. Ask yourself, are you choosing based on emotion or structure? Because one of those builds long term strength and the other just feels comfortable. And in finance, comfort rarely wins.